Well, after the Bank of Canada's third consecutive rate cut, investors are now closely watching south of the border for a rate cut from the U.S. Fed, with growing anxieties of a slowdown in the U.S. economy. Let's bring in Diana Avigdor to talk about it further and talk about portfolio positioning at the firm at which she works. And as a senior member, she's portfolio manager and head of trading at Barometer Capital Management. Diana, it's always great to join you. Thanks a lot for making time for us today. You've said recently in some of your notes, capital preservation is now key at Barometer for its clients. What does that exactly mean?
Well, thank you, Paul, for having me, and happy BNN 25-year anniversary.
Thank you.
Old leaders are now laggers, so growth has been replaced with anxiety about growth. So the air in the market has kind of changed, just like we're going into fall. And markets have done very well this year, with the U.S. markets up, over 15%. And even though we're having a little bit of challenges, we're a little bit off our highs, but not all too much. So we've had great performance so far this year. So the objective, given the change, is making sure performance doesn't suffer too much, given the challenges. What that means is September is rarely a good month in markets, and especially now where bad news is just bad news for the economy. October is sometimes tough as well. So seasonality is certainly something to watch. And buybacks that have been the underlying bid to the market, but are going into blackout around September 13. It almost feels like the street's positioning themselves for that. 50% of the corporates will enter buyback blackout. So capital preservation is key. Growth stocks, think NVIDIA, things that have really rallied a lot are now underweight and replaced with stable dividend, large cap paying stocks as we wait out the volatility. Our portfolio footprint is wide. In other words, that means largely diversified with small overweights and underweights. But no new positions are added in this market environment until it shakes out enough and stabilizes.
You at Barometer and your colleague David Burrows has made this point, are overweight financials. Does that include Canadian financials as well as U.S.?
It does. Out of the banks that we have here in Canada, our favored are CIBC, Royal, and National. With CIBC, valuation is still at a discount to the group, and we like the domestic exposure as opposed to others that have some issues, perhaps Scotia, the global aspect of it, or TD with its AML issues that it needs to work out at. National is also a domestic story. Royal, most diversified in terms of business lines, putting up the best ROEs right now. So that is what we own in Canada.
And you're overweight industrials as well, and a subset of the industrials is the defense stocks, not defense as in defensive, but defense as in the developers of weapons systems and military technology.
Certainly one of our stocks in that sector is General Dynamics. Long visibility of earnings, 7% growth in yield, seeing growth in business aviation as well, of course, weapon systems, financials intact, debt decreasing, margins stable at double digits, revenue consistently growing, and like I said, with long visibility as contracts with the U.S. government are long-term in nature. So you have an earnings outlook that is not volatile, oftentimes with some of the larger themed stocks like the technology, which is now underperforming a little bit. One of the things that keeps it volatile is that the earnings quarter over quarter constantly jump up and down. With General Dynamics, you have quarter over quarter stability and expectations.
And a new name that you've added to client portfolios is Campbell Soup. That's interesting. Tell us why. That stock has done very, very well over the past year.
Campbell Soup, simple. Soup. Nothing exciting about Campbell's, but with the theme of what we're talking about here and making sure that We don't give back any of the performance year to date. It's stable, most importantly, boring. Revenues growing at about 3%, with margins stable but at 31%. Everything is stable and consistent. This is the kind of market we are in, and this is the kind of stocks that we're going to like until it stabilizes and we have a new trend, or until we know what's happening with the rate cut in the U.S., whether it's 25 or 50. And what it does to the stock markets. Frankly, it seems like the Fed waited a bit too long.
Diana, thank you.